about in the 60s, 80% of the world's population lived in countries that had an ecological surplus. That means the countries demanded services and resources from ecosystems in quantities smaller than what they had within their borders. Next slide. Just the next slide. And today, 80% of the world's population live in countries that we call ecological debtors, meaning that they demand more resources and services than what they can provide within their borders. Now, of course, trade is a fact of life, that we're not saying that countries should be living within their own borders, but being an ecological debtor implies a greater dependence on imports. Sometimes it also can lead to overuse of your domestic resources, and also a higher likelihood of being very carbon intense. Next slide. So we basically have a big accounting system where every country has both assets and liabilities, or it has biocapacity and also has a demand on nature. And we look at that in these 6 different land types, including the amount of land necessary to absorb carbon. Next slide. So these were our collaborating partners when we first started. Go next slide. And so what we found in our first round of research was that resource constraints are definitely significant and material to macroeconomic health and potentially creditworthiness. That countries were very unevenly exposed, and that the impacts could be significant enough, to have significant macroeconomic health impacts, and also that the time frames are not always long-term for these sorts of risks. They can also be show up in the medium and even the short term. So that's one of the things that I think is really important for us to start to think about with regard to climate change and resource constraints. These issues may accumulate over time. And in that sense, they're long-term issues, but their impacts can be felt in the short term, and sometimes suddenly. So there's three mechanisms that we're looking at. One is degradation, overuse of, it could be soils or fisheries. Another one is trade-related risk, which is just the exposure of a country to commodity prices. And then the third is what the result of carbon emissions could be either physical climate change or transition risk. And so in a 2-degree world, we are seeing, a lot of rapid changes in energy makeup in countries, and how prepared are countries for that kind of a transition. Next. So really quickly, the degradation risk, we just did a simple stress test on the countries we looked at. Next slide. And just really simply looking at what would be the impact on trade balance if a country lost about 10% of its productive capacity of its ecosystems. So that's just assuming that, for example, in Brazil, if its forests were producing 10% less, how would that, they would probably need to import the balance, and how would that affect their trade balance? So we've run this analysis on over 150 countries. Next. But what I really want to talk about a little bit more in depth is the second type of risk, which is trade-related risk. We just finished a round of research with UNEP-FI, and really we're trying to look at number one, what are the drivers of commodity price volatility, especially with food? And then what would be the impact of a food price shock? Next. So these were our partners. Go ahead. And so we basically modeled, we did a stress test modeling a rapid doubling of food commodity prices, similar to what we saw in 2007, 2008. And of course, we do have low food price, commodity prices right now, but there are quite a few very persistent drivers that are kind of setting the stage for potential food price shocks. We can't say when, but the chances are increasing. What we did with the research was took a look at what would be the impact on GDP, current account, and inflation for over 110 countries. Basically, the framework looks at, as I said, some of the drivers. So we have a combination of both drivers on the demand side and the supply side. On the demand side, of course, we have increasing populations, higher incomes leading to more meat-based diets. And then on the supply side, there's not a lot more land that can be converted to cropland. There's some marginal land that can be, but not to the extent that would probably meet the rising demand. And also the increase in cropland productivity, there's not a lot of additional gains that can be made. There are some in Africa, but overall we're starting to see this divergence of supply and demand. So we're looking at that gap. We're looking at then how that contributes to higher and more volatile global prices for food commodities, and then what could be the potential impact on economies. Next. So we think that demand will increase between 54% and 98% due to population and income growth, and as I said, limited possibilities for extension or yield increases. And then these trends are kind of exacerbated by climate change as well as water scarcity. Overall, since 2007, we're seeing a big difference between the food price, monthly food prices being higher than average, as you can see in this chart. So we ran, as I said, we ran the analysis on looking at GDP, trade balance, and inflation, and the obvious the countries with the highest positive effect for GDP are obviously food importers, but many countries, the effects of negative GDP are affect many more countries, and overall the effects are really come into play when they're compounded. Countries that have all three impacts are really the ones that have sort of the biggest macroeconomic impact. So these are the countries that have the GDP effects. Next. Current account effects. Keep going. And inflation. So just a word on inflation. About 23 countries of the sample saw an increase in inflation of over 10%. And many of these countries are countries that already have, some weakness in terms of social dynamics. Countries like Morocco, Bangladesh, Egypt, and Indonesia. So that's something to be concerned about. Next slide. As I said, really the important thing is to look at the countries where all three of these dynamics come into play. And countries, this slide shows a sample of one of the of a partner who applied the model to their sovereign risk framework, and these are the countries that experienced downgrades. I think the basic drivers of these results are those countries that are dependent on food trade and also have a high percentage of household expenditures on food. But you can see some really important countries from an investment perspective, like China, Indonesia, and also countries like Egypt, Morocco, and Philippines and Turkey are all negatively affected. All right, that's the results of the research. I think we can open it up for a few questions.
Thanks, Susan. So if you do have any questions about this portion of the research that we've done, the ERISC methodology and the results from the two reports, please do either raise your hand and we'll try to unmute you and you can pose your question to the plenary, or just type in your question into the question and answer box or the chat box to your right, and we will pose the question for you. So we have one question here, which is, what is the time frame you're looking at for potential changes in sovereign credit risk or country risk?
Good question. So it depends on the research that we're doing. In this particular case, it's a food price shock. So it's just assuming that one occurs, and we can basically look at what the drivers are and the increase in likelihood, although we can't really predict the trigger. So in terms of the food price shock research, I would consider, I'd be interested to hear from Moritz actually about how Moritz, you might think about incorporating this kind of potential into a risk rating, because it's kind of like a bit of a black swan event. It could be it's an unknown, but it could be a possibility. It's not something you can directly predict, though. Did you have a perspective on that, Moritz, in terms of time frame?
Yes, thank you very much. I can speak to that in a moment when I give you my introduction, but just for now, I think usually when you look at sovereign credit ratings, like other credit ratings, you tend to have a longer-term time horizon of 5 to 7 years. However, if you have an event that is happening very quickly and was expected to have a lasting impact on the economic and financial realities of a country, this can go very quickly. We can give you an example which is totally unrelated, but when the United Kingdom voted to leave the European Union, 2 days later we had a double notch downgrade, right? Because this was like, you could say a black swan. This is what people, or at least the dark gray swan, because very few people had anticipated that happening, and we take an immediate consequence. When I make my presentation in a moment, it's going to be about sort of catastrophes, and that's probably a more quickly moving event than than the food shortages, but if you have a gradual deterioration of food supply, I think it would gradually be reflected in the ratings.
Yeah, thanks, Moritz. Thanks, Susan. And that's something that we're seeing in some of the other work that we're doing also, that these environmental issues that we're trying to look at here tend to move fairly slowly. So incorporating it into the averages of environmental changes is difficult in the time frame that most financial institutions look at these issues. So often the type of scenario shock analysis is really where we see the big impacts, and that then it just becomes a question of what is the probability of a shock or the probability distribution of a shock in the time frame that we're looking at. We had another question here which I can answer. So the question about, we looked at 78 countries for sovereign risk impact, but Susan mentioned that over 150 countries were analyzed. So we ran the economic analysis for 110 countries. So we have economic data or impacts for 110 countries, but the particular credit model that we used to get a sense of how this might impact the rating of a country only covered 78 out of those 110 countries. So that was a constraint in the credit model that we were using, and not a particular choice of the researchers. Should we take one more question before we move on? Is that okay, Susan? Mm-hmm. Okay. So, and this might also relate to the resilience debate, which we're seeing emerging from this discussion around sovereign risk. So, downgrades seem to be only for emerging countries. Is there any particular reason for this? Are there other factors driving this? For example, that their fundamentals generally are already weak. So is it factors beyond environmental issues, or is it why do developing countries appear to be particularly impacted by this type of analysis?
Good question. It's something that we see across the board, both with the food price shock work as well as the impacts of climate change, is that the countries that are contributing to the drivers, such as carbon emissions or higher meat-based diets, higher incomes, are often not the countries that are on the receiving end of the impact, and often they're countries that already have low credit ratings. And I think Moritz, you could talk more about that too. But they also tend to be countries that have a higher household spending on food, and can also be quite import dependent. So yeah, their macroeconomic fundamentals are not set up to absorb a shock like a country like the United States, for example. Moritz, do you want to say more about that?
Yes, I think in general what you see is obviously sovereign creditworthiness is the outcome of a large array of sort of overlapping and interdependent factors. But many of those have one thing in common, which is showing that developing economies in particular are much less resilient to shocks. Right? They are sort of more dependent on a stable environment because they simply don't have the prosperity and the resources and the institutions to absorb the shocks as well as the rich countries do. So if you have a very rich country and food prices rise by 50%, say. I mean, this is a shock to the economy. But if you consider sort of the relatively low share of food in the economy overall, especially the raw food, and I'm talking about processing, which is very often most of what you see in the price in the supermarket, it's actually quite digestible. You might have a bit of inflation, but it's not that the economic structure changes sort of beyond recognition. If you have a very poor country, where even in good times, sort of swathes of the population are just scraping by in terms of their daily calorie intake, it's quite a different story. Now, these are two extreme examples, but it shows you sort of the width of the spectrum. You just have much less buffers for absorbing shocks in developing and emerging economies. And as economies grow richer and wealthier and more diversified, they build those up, and therefore they tend to be able to withstand those external shocks much better.
Great, thanks, Moritz. We're still getting some questions coming in, but I suggested we move on to the second part of the webinar, which is going to talk about carbon and climate risk. And please do keep sending in your questions, and we'll try to tackle them during the next Q&A session. So, Moritz, please go ahead.
Okay, thank you, and thank you everyone for attending this web call. It's a pleasure to be with you. I'm Moritz Graham. I'm the Chief Rating Officer for Sovereign Ratings at S&P Global Ratings. Maybe I should, for some of you, just give you a very sort of 1-2 sentence summary of what a rating is. A rating is basically a forward-looking opinion which describes our view of the probability of the sovereign not being able to honor its financial obligations, so that they would default, as we say. So it's not really a judgment about the quality of the government or whether we like or do not like the regime for political and other reasons. It's really just very narrow, measuring the probability of default, and that's why interest of investors is great, because that's what they're interested in. Now, we've been looking at climate change recently much more than we had in the past, partly because we think that climate change and associated risks are one of the two big mega trends that will span over the 21st century, with the other one being aging societies. And as Anders said, these are pretty slowly moving developments, so it's very difficult sort of to see a big change from one year to the other. This is the nature of the underlying development, but of course over a longer period of time, these things become quite relevant. And remember that we have longer and longer government debt circulating in the market, so longer-term issues are increasingly of interest to investors as well. Just last week, Korea issued, for example, a 50-year bond. I think Mexico issued a 100-year bond. So, these are time frames which, of debt instruments which we rate, and the effects of climate change fall well into that. Having said that, in the past, we have not really changed ratings on that factor. But let me first tell you what we did, what the research is about. We have heard from Susan the importance of one facet of climate change, how it can impact, for example, the availability of food, and how those supply constraints could impact sovereign creditworthiness. So what I'm going to present now is another risk that we expect will be exacerbated through climate change, which is that of natural catastrophes. So both of these studies, the one that Susan presented and that I will quickly summarize, are sort of complementing each other. But even so, I think we need to be mindful that this is not a full picture of all the facets of climate change. Some of them we still don't really understand very well at all, and we'll be in for 1 or 2 surprises, I'm sure. But I think it's good to present these two together, because they look at two different facets of a joint phenomenon. So what we did, and I should also give credit to Swiss Re, the reinsurance company that provided us with critical data on natural catastrophes, on the damage that is done by natural catastrophes. So we're looking at very big events. We're looking at 1 in 250-year tropical storms, or floods, or earthquakes. And if you look at the first chart that I've prepared for you, what you can see is basically sort of the potential downgrade of ratings, and that you see on the x-axis, spanning from 0 to 2.5. if a 1 in 250 year catastrophe would occur. And you can see this is sort of color-coded by earthquakes, tropical cyclone, and floods. So you can see that if a big event happens, you could have double-notch downgrades for some sovereigns. But of course, these are rare events, and therefore we don't really incorporate them in the ratings. The estimate that we have here is status quo, so that means, so this is a 250-year disaster as we would expect it today. Now, we do expect that, apart from earthquakes, obviously, that natural catastrophes will actually become more frequent and more severe as global warming goes on. And therefore we think that that the ratings impact will be bigger, and you see that on the next slide, well, on the one after that actually. So what you see here is basically a list of vulnerable countries, to various degrees vulnerable, where you see, just as an example, with more data in the study, a 250-year cyclone, a tropical storm, in the gray bars basically show you what would be the damage, economic values of the total properties in the country. And the red bars on top, that's the increase in damage that we would expect because of climate change, living in a 2% world. And of course, if we were to live in a 3% world, the red bars would be even bigger. So you can see in extreme cases, up to between 10 and 20% of total properties in the country would be destroyed. So that's the severity, and you can clearly see that with climate change, the severity will increase. On the next slide, you see the same depiction, but not the damage, but you see the sort of notches of downgrades. So if you look at the country sort of in the Caribbean, for example, you see very big downgrades. And the black or gray bars again show you what I showed you in the first slide. This is the status quo downgrade impact of a 250-year catastrophe, and these are only again tropical storms here. And the red bars would show you the additional downgrade that you would have because of global warming. So you can immediately see that global warming makes things worse. But of course, with or without climate change, even the status quo is highly perilous for many sovereigns, and it tends to be, unsurprisingly, small sovereigns that are not very diversified geographically, so small island nations, for example. And you can see on the next one that, which is basically showing what we just discussed previously in answer of the question, sort of the less resilience of developing economies. So basically you see here, if you hold the slide here for a moment, these bars show that, for example, the additional damage because of climate change. So that's what coincided to the red bits in the previous slides, which is the additional bit for because of climate change. You would have in a 250-year storm or flood, you would have for advanced economies an additional 0.13% of values would be destroyed. That's not very big. And you see that for GDP per capita, you would lose like 0.16%. Again, that's appreciable, but it's hardly moving the story. And of course, the rating consequences will be quite small. So now, if you compare that, and for that, if you press enter again, you will see that for developing and emerging economies, the impact is much bigger here. So that is just sort of our finding, which corresponds to what we just discussed, that the resilience of developing and emerging economies is much lower, and therefore the impact both for loss of GDP but also as a consequence of ratings is much bigger. And if we break that out by categories, by regions on the next graphic, you can see that Latin America and Asia are particularly prone to be hit. So these are the same variables on the x-axis. The additional damage because of climate change, the additional GDP per capita loss because of climate change, and the additional downgrade risk. And you can see that Latin America and the Caribbean, specifically the Caribbean, is sort of the most impacted by that because of the severity of tropical storms and because of the fact that these tend to be relatively small geographies. So if the storm hits, it hits a relatively large part of the country. If the storm hits Florida, it hits Florida, but that's a relatively small part of the U.S. So how sort of geographically diversified you are makes a big difference, other than the mere location of your place. And you can see that European countries, we didn't really find that the natural catastrophe element of global warming and climate change would have any impact on a lasting impact on their ratings or on the economy. But again, this measures just one particular partial facet of global warming, which is to do with natural catastrophes. And of course, this is only partly surprising because we know in Western Europe, for example, there are not many natural catastrophes of the climatic nature. You have winter storms, but they're not very damaging compared to tropical storms, for example. The big risk that we have in some European countries like Italy or Turkey is earthquake, and that's big. But of course, it's not a factor that will be influenced by climate change. So this reconfirms some of the findings that the poorer countries are more impacted by climate change, and also their credit rating might be more impacted. On the map, you can basically see color codings. If you move the slide, please, you can see sort of color coded the vulnerable and the least vulnerable countries. The redder you are, the more vulnerable you are to climate change. And again, we see that the tropics is particularly at risk here. And of course, the Caribbeans, being so small as they are, we don't really see them. But trust me, they would be pretty red throughout. So that's that's not a new finding, but I think we can corroborate sort of the previous findings of research from the credit rating angle. Now, one thing that you can do to reduce the impact on your rating is to try to insure yourself against these risks. And what you can see is on the next slide that if you had this is a hypothetical scenario where you have a 1 in 250 year catastrophe which creates a 5% damage to value, meaning that 5% of your economic hardware and values and properties are wiped out by the storm. It's a lot, or the flood. And if you have no insurance against it, the rating would go down by over 2 notches, 2.5 notches. If you insure half of that damage, then the actual downgrade could be reduced by more than half, because much of the cost will be borne by foreigners, because most of the insurance and reinsurance industry, of course, it's not in the Caribbean, but it's in Europe and the US and Japan. So outsiders would pay for that. So the pressure on the balance of payments, the pressure on investment and growth would be less than if you're not insured. But while this sounds good in principle, we need to keep in mind that the insurance market is not very developed in emerging and developing markets. And the added insurance that you would need, you see that on the last slide, in order just to avoid the downgrades created by climate change, are pretty high and probably just too expensive for many. Take the Philippines, for example, where we had a big storm, of course, a year or two ago. Just in order to eliminate the additional ratings impact, negative ratings impact of climate change, you would have to insure over 60% of your overall assets in the country. That is an exceptionally high number, even for many developed economies, advanced economies. So yes, you can mitigate it through insurance. Of course, that's not for free. You have to pay for that. Insurance companies are not charities. You need to pay for their protection. But probably the amount of protection that you would need to buy would exceed the financial capabilities of many of the most affected countries. So there is a glimmer of hope, obviously, in terms of this financial instrument that is insurance, but I think this market needs to be developed further. And right now we think that this is only a very partial solution to the credit and growth challenges that especially the emerging market and developing markets in the tropics would face as the climate changes. So while we have only so far changed one rating, which was Grenada after Hurricane Ivan because of a natural catastrophe, in some cases, there were some contributing factors, but this was the only case where we really said it was because of a natural catastrophe. having looked at the numbers and the simulations that I quickly share with you today, I think that in the next couple of decades we might actually be looking at this more frequently. So hand it back over to you, Anders. Thank you.
Great, thanks very much, Moritz. That's some fascinating research there. And are you going to try to do more, get more insights from the Swiss Re data that you've been working on?
Well, for the time being, I think we have probably squeezed all out of what we can. What I would be interested in, and the data has so far been the constraint, is to look at the impact of droughts, for example, right, which is something that is halfway between what I just presented and what Susan presented before me. But we can expect that in many sovereigns, especially sort of in the Middle East and North Africa, this will be a key result or consequence of climate change. And of course, being based in Europe, this is particularly interesting, even if you're not impacted by it, because of the migratory flows, which has been the dominating theme in Europe over the last 18 months or so. So I think this is sort of an area of research where the understanding is still sort of insufficient, and I think highly relevant not only for the countries that are impacted, but also for the countries that might be impacted by the secondary effects of the droughts, which are the rich nations in Europe. And some observers have stated quite rightly, I think, that part of what we see in Syria is partly a climate consequence, because maybe this conflict would not have erupted the way it had if they hadn't had a string of droughts which deprived the rural population and therefore created more resistance against the regime.
Yeah, absolutely. And Syria is not the only place where we're seeing migration or unrest that can be linked to environmental issues. So that's certainly a very big topic also in the development community, not just in the finance community. But it's interesting that you pick up droughts. Because we're so UNEP-FI through the National Capital Declaration is actually working on a drought stress testing project right now, where we look at Mexico, Brazil, the US and China to see the effect on bank portfolios. Now this is corporate loans, so different from sovereigns, but we have developed a number of drought scenarios for these countries, which maybe you would want to look at for your drought work. I think it could be interesting to see if we can use that type of methodology to extend it to sovereigns. But let's go to some of the questions. I think there's a number of questions coming in, and we are running a little bit short on time, so I think that we are I'm going to use my privilege as moderator and just pick one, and then we can move on to Susan's next presentation and come back to some of the other questions. So the one that I'm going to pick for you, Moritz, is so the increase in damages caused by natural disasters is a consequence of climate change, but also the simple reason that the infrastructure at risk is bigger. So there's more houses, more roads, more bridges, even more people than before. Do you have a sense of the breakdown for how much the increase in damages is due to climate change itself, and how much is simply due to an increase in exposure?
I do not have that data. Maybe Swiss Re can break it down further, but I think it's very complex, and the question is really an excellent one, because it's the cross currents. So there are more people, and more people live in cities. More people live in low-lying areas, in coastal areas. Therefore, there's more at risk at the same time in many countries as growth and prosperity increases. So the quality of the infrastructure, meaning so the resilience, is also improving, right? So you build better houses, and you have better infrastructure for, to deal with flood, etc. So what I presented to you was merely the net effect of all these factors. But the way we discussed it with Swiss Re, the impression that I had is that they're basically trying to assess and carve out in the numbers that I showed you the climate effect. Maybe that's why it's not so huge as some of you might have expected. But I think what we're looking at here, the red bars, you should consider as climate effect.
Okay, great. Thanks very much. So we'll move on to Susan's next.
Great. So yes, the third topic we wanted to talk about today is the topic of carbon intensity of economies and potential transition risk. And so just to take a step back, with the passage of the Paris Agreement, now that it's actually in force as of November 4th especially, the likelihood that governments are going to be moving in a low carbon transition is much higher. I mean, from an investor perspective, there's a lot of uncertainty as to how governments and how vigorously governments will be implementing new policies, to what extent they'll be adhering to their INDCs or even strengthening them. Just as there's a lot of uncertainty around physical impacts of climate change. So from an investor perspective, it's not always easy to predict, but obviously the chances are higher. And so this year we've seen a really an incredible increase in the number of investors that are interested in looking at transition risk. I was just thinking, a few years ago, a lot of investors would say, well, the governments of the world are never going to agree, or probably won't agree, so we don't have to worry about it. So there's been an amazing ramp up in the ability of, investors to start to get their head around this. So we have also seen an increase in the interest of investors to disclose on carbon risk in their sovereign bond portfolios as well. So, once they've gotten equities under their belt, they're turning to their fixed income portfolios and saying, well, how do we disclose the carbon risk in these? So we formed a working group of 8 investors earlier this year, and we've been working on that. And I just wanted to show you a few of the, early kind of concepts and results that we're coming up with. We've been grappling with things like, to what extent are the ways that we're reporting on carbon and equities transferable to sovereign bonds? It's a very different asset class. With equities, you have investor engagement is totally different than with countries, of course. So we've been really taking a fresh look at it. Overall, I think the consensus in the group is that we really want to start to look at the carbon intensity of economies, what are their structural characteristics, and how might a transition to a lower carbon world or a carbon-constrained world, how might that translate into risks at the country level. And so the first way of looking at this is to say, well, in order to keep the warming to 2 degrees, we've got a certain carbon budget estimated at about 900 gigatons between now and 2050, which gives you a global intensity benchmark of about 0.18 kilograms of carbon per US dollar. So, and then you can look at the carbon intensity of countries and see what is the gap between their carbon intensity and the global carbon intensity benchmark. And this is, of course, isn't a precise measurement of risk, especially default risk, but it shows an exposure to some of the risks that could be coming down the pike, whether it's policy change, regulations, competition from other countries and changes in trade flows because of that, and also just technological innovation that's happening and the cost of renewable energy coming down very quickly. So this is a starting point. And if you look at the next slide, oh, that's my dog. Sorry. The next slide shows an additional enhancement that we've made to this kind of analysis to say, well, not all countries and not all sectors are created equal. If you actually want to look at how carbon dependent an economy is, how economically dependent an economy is on carbon intensive sectors. So an indicator we've developed is called intensive sector burden, which shows that it is basically comparing 57 sectors of every country and comparing them to the average sector worldwide and saying if that sector's more carbon intense than average, then it's overweighted. And then if the country's, it's also weighted depending on how economically dependent that country is on that sector. So for example, in China, it's 44 out of 57 sectors in China are more carbon intense than average, and that's why you can see this indicator is much higher. And again, this is just an exposure metrics. There's a lot more research we'd like to do into specific sectors, looking at the age of infrastructure. We also haven't looked yet at fossil fuel reserves, this idea of unburnable carbon, and what impact that might have on oil-producing nations, for example. This is purely looking at carbon intensity. If you go to the next slide, I just wanted to point out also that, of course, the usual suspects are the sectors that that are most carbon intensive: oil and gas, coal, electricity generation. But there are also many other sectors that are more carbon intense in China, for example, including food and beverage, and tobacco, wood products, and clothing. So I think if you really think about the transformation that our economies are going to be undergoing, it's much more widespread than just these particular sectors. And then next slide. So we also wanted to start looking at the INDCs, and so one of the benefits of looking at a carbon intensity approach is you can say, well, what's been the track record of the economy so far in decarbonizing? So you can look at the rate of change in the country and then maybe compare it to the rate of change worldwide that would be necessary in a 2-degree carbon intensity scenario. And in this example, we adjusted that for sort of expected GDP growth. Next slide. And then you can take a look at individual countries. And so this is just an example of Spain, Germany, and Brazil. What do their INDCs say in terms of their decarbonization compared to the red line, which is the global carbon intensity scenario. So that's just a little bit of a preview. Some of this data is available, and we are going to be coming out with a report, hopefully at the end of November, laying out, the results of what we've done in this working group. So I think we can turn it over now for questions for Moritz or myself or Anders. We have about 5 minutes left.
Thanks, Susan. Actually, I have a question to your presentation. How would investors use this data or this insight?
Mm-hmm. Well, a couple of different things. I think, if you really want to take transition risks seriously, these results can be used to tilt portfolios. Could also be used to build indexes or funds. Because carbon isn't really priced right now, by and large, there may be a way to to have investment approaches that give you the same exposure, but kind of have a built-in low carbon bias, so that in the event the carbon is priced, then your portfolio would be more robust. I did want to say too, there's, it's a lot of the people on the call would probably have lots of opinions about this, because it's, this kind of approach is very unique to an investor's philosophy overall. But, yeah, I'm not saying, I don't know what investors would do with the information. They may decide to not invest in certain countries, or just, shape portfolios to be more resilient. Oh, I would also say just a couple things just to get in there. And if investors want to take a step back and look at this picture and say, well, it's really, what do we want to do on the opportunity side as well? I mean, is this all about reducing risk, or do you want to get involved in, investing in green bonds or low carbon technologies in order to kind of take advantage of the opportunities that are arising as well?
Great, thanks, Susan. That's very good to hear. So there's a lot of questions coming in. We have 2 minutes left, so I'm going to. There's a few sort of classes of questions that are coming in, and one of them is around green bonds, sovereign green bonds. Can they be used to increase resilience in a country? Are they the answer to try to mitigate some of these risks? So we've seen a lot of activity in corporate green bonds. So sovereign green bonds, are they the answer? And Moritz, I'm unmuting you now so that you can also participate.
Yeah, I just want to say really quickly, France just issued a $9 billion sovereign green bond, and I'm personally hoping that that is something that we can encourage more. It's those very countries that are struggling to attract capital, whose credit ratings are being also impacted, that need this kind of investment.
Thanks, Susan. Moritz, do you have a view on sovereign green bonds?
Well, I think we'll see more of them, but I would expect they will remain a niche market for quite some time. It's also much harder for sovereigns to issue green bonds because of the nature of their public finances. It just goes into the treasury, and then they do they do everything with it. It's not like a company that can invest in green technology and specifically dedicate those funds to that project. Most of the spending of governments is general purpose spending. So I think it will grow because there is investor demand that is growing, but we should not expect that it will be a very significant part of sovereign issuance in the near future. I'm skeptical.
Okay, thanks, Moritz. Again, if you have any questions, please enter them into the question box or put up your hand, and I can try to unmute you. I realize we are at the top of the hour now, but I might ask our panelists for maybe a few more minutes of their time to go over some of these questions. Susan, maybe this is more for you, although Moritz, you can also, of course, jump in if you want to. Advanced countries, I guess intuitively, have moved a lot of their carbon-intensive sectors to emerging markets, like, for example, China. And how do you factor that into this type of carbon analysis, or how do you factor in that transition?
Yeah, I think that's really important for investors to look at. And so, what's typically done is to look at the carbon intensity of production of countries, but of course that doesn't take into account trade and the fact that a lot of the carbon is in their imports. So we're also recommending that investors look at the carbon production, carbon of consumption as well. So you can look at that on a GDP basis or a per capita basis. And I think that's a little bit more of a balanced approach. I think carbon in trade is really important, and if we don't incorporate that, you'll end up exacerbating the kind of offshoring of carbon production, and then your investor, in terms of your goals as an investor, could be thwarted. So I'd say there's risks on both sides, carbon production as well as consumption.
Yeah, for the research that we did, I don't think it matters where the carbon is produced, because for the tropical storm, hitting whether CO2 originated in China or in France, it will be the same effect. So we don't factor that into of course, you have to ask the question.
Moritz, we can't hear you very well.
Okay, I'm sorry. Can you hear me?
Yeah, much better.
Okay. I was just saying the fact, the origin of the carbon that creates the climate change and therefore the storm or the flood. Doesn't matter where it came from, and the effect is the same. And as long as the economic models of countries are intact, I don't think we could or even should include that in our assessment of the likelihood of sovereign defaulting. We might have our personal views as citizens of the world, but it's not a credit issue.
All right, thanks very much. We are now 3 minutes past the hour, so do we want to take more questions? Or Susan, Moritz?
I'm fine with it. Okay with me.
Okay. This is more for you, Moritz. Many factors go into the analysis of sovereign credit ratings. How much weight do you give to climate change in your models currently, or is it essentially treated as an event risk as presented in the research?
That's an excellent question. We've been debating that a lot in the preparation of the studies that I presented. So climate change is not an explicit factor in our rating. The way it feeds into the ratings would be through the usual channels. We think that for example, natural catastrophes or food shortages can have impact on the balance of payments. It can have an impact on the fiscal accounts, the budget of the country. It can have an impact on the growth outlook. It can even have an impact on the way society works and whether or not the social contract is debilitated. And these are all factors that we include in our rating assessment. So similar to aging, which I described as the other mega trend of the century, we're not using this as an explicit factor in the criteria that we apply, but we think that climate change is something that will impact those variables that we have always looked at.
All right, thanks very much. So a lot of the other questions that have come in are along the similar lines of what we have already spoken about. There's a few questions around the insurance cover, which we may or may not be able to respond to. So, Moritz, if you want to respond to this, let me know. What about the additional insurance coverage to be provided by developed countries? It will sort of working like a green climate fund. Insurance can really align incentive structures of all the actors in a more climate-friendly way, which will be on top of technology transfer and capital transfer. So insurance as the next defining axis for climate cooperation is Is that something that we might see?
It could be. I mean, the most obvious way, of course, would be to use the formal insurance industry that already exists and that does insure against these catastrophes, although not with a lot of coverage in many emerging and developing markets. But there are also opportunities for the multilateral development institutions here, I believe, because if we are only half right in saying that climate change will impact the development, especially of the more vulnerable and poorer nations, it seems to be a clear mandate to mitigate and prepare those societies for it. So that's kind of insurance, if you like. And many of the multilaterals are actually sort of very much aware of that and have prioritized their operations along those lines. So I think there is quite a bit of movement here, actually.
Okay, that's interesting to hear. Susan, would you want to feed into that?
I just had one point. I just got back from the World Bank IMF meeting where there was some talk of, and it's a very emergent strategy, but it's called state contingent investment instruments, which means payment terms are kind of could be adjusted if a country, this is something baked right into the bond. So if a country experienced a shock, it would automatically adjust the payment terms, and it is really a form of insurance. And I wonder, Moritz, is this something that you think S&P would rate at some point, or have you heard about this? Is this a realistic approach?
I think that there are these early stages really of development. What you need for rateable security is actually sort of a well-specified contract which clearly describes and delineates the financial responsibilities for the various parties involved. So it would depend really on the harmonization and standardization of these instruments, whether this can take off, whether it's imminently rateable. I think under the right sort of legal setup, I think yes, that could happen. But it takes someone to take the lead on that. And I think that this might be actually something that multilateral development institutions would be well placed to investigate.
All right, so a little bit of work for the international development community and a lot of work for the international finance community to improve their understanding and consideration of these factors on sovereign credit and on other types of assets that we invest in. I would suggest that we, as we are approaching 10 minutes past the hour, bring this to a close. We have saved your other questions and will, of course, try to respond to them individually. The presentation material will be made available to all the participants of the webinar. We'll send out a follow-up email with links to the presentation material, and we should also be able to make a recording available if the technology has been friendly with us. UNEP-FI and Global Footprint Network, of course, are continuing to work on these types of sovereign credit issues and country risk, as we heard from Moritz. S&P is working on it. So expect much more work, much more from us in the future, and we look forward to discussing these types of issues with you on future webinars. I'd like to thank the audience for attending, and a big thank you to both Moritz and Susan for giving such fantastic presentations.
Thank you, Anders. Oh, should we also say if we'll be making our reports available? I think S&P's report and our report should we be sending those out, possibly?
Sure, we can include that in the follow-up email also, so links to the reports that are being referred to in this webinar will also be included in the follow-up communication. That's a good point, Susan. So if there are no final comments, Moritz, Susan?
No, it's been a pleasure. Thanks so much.
Thank you very much. Have a good day. Have a good evening.
Thank you, and thanks to everybody. So this closes the webinar. Thank you for attending.